to make the comparison between gambling and financial markets, there's the element of risk and there's the element of discounting the risk that I think are very similar. And in that sense, I think these behaviors are very similar to one another.
Hey there, my name is Eric and you're listening to Delve, the official thought leadership platform of the Desautels Faculty of Management at McGill University. So today I'm speaking with Taha Havakhor, Associate Professor of Information Systems here at McGill University. And we're talking about this shifting landscape in consumer investing. So consumer investing is when regular people participate in financial markets. And in recent years, thanks to the internet and various financial technologies and applications, it's easier to do that now than it ever has been before. And for Professor Havakhor, that could be risky business. So in a recent study, he looked at how consumer investors access complex financial data online to help them make investment decisions. And he found that this extra information led to riskier bets. Behavior that, as you'll hear in today's interview, is strikingly similar to those of gamblers. So there's a lot to unpack here. Financial technologies were supposed to be the great democratizer of financial markets. But these findings suggest that there could be a limit to that. And they also show us how hard it is to convert data into useful information, especially if investing isn't your full-time job. So I'm excited to welcome Professor Havakhor to talk about it. So let's delve into it. Professor Taha Havakhor, welcome to the Delve Podcast.
Thanks for having me.
So today we're talking about a lot of things. So we're talking about investing, we're talking about risk, we're talking about making mistakes with investing, and kind of at the center of it all, there's this technology and the accessibility of information. So over the past 10 to 20 years, the internet has really done a great job at making a lot of things more accessible to people, to investors, so that they can make more informed investment choices. But some of your recent work kind of challenges that a little bit and kind of points to some of the risks involved in depending too much on these information sources to make your investment decisions. So I'm excited to unpack that with you. So we're going to be talking about APIs. So that's Application Programming Interface. That's an application programming interface. So that is a kind of technical term. So I'm going to lean on you a little bit to kind of maybe just, if you can just give us an overview of what an API is and how it works and how that works in the world of finance.
That's an absolutely fantastic question to ask. APIs, by and large, allow us to do two things. They allow us to do data operations, which means that we could just use it simply as a layer to access a larger data in a format that you could really work on it, right? If I put it in the terms that are more understandable, if you wanted to open your data in an Excel format, there are several things that you have to do as a data engineer to prepare it and massage it and create it as a table that is an Excel format. And Data API allows you to access very complex data without knowing data engineering in a format that is proper for you, oftentimes as a CSV file, oftentimes as an Excel.
Got it. That makes sense. Okay, so let's say I'm an investor and I would like to know kind of the data around a certain stock. We'll say, I don't know, Google. And then I can access this API and I can request data about Google, historical performance. Am I getting that right?
So yes, you could use the API for that. Now, trends data is a very hard thing to gather if you're not using an API. Unless you have been tracking every stock target every day and you have had a data set, you won't have access to that. What Yahoo's API offered to the customers was that, well, we are Yahoo. Every day we have tracked of that information. And guess what? With a click, I could give you the history of all the traded stocks that are listed in market X or market Y, with various numbers, various historical numbers that are available, that are going to be available to you. So the benefits of the API per se was that the customers all of a sudden would have access to this historical data that is massive, that they could not collect by hand and all of a sudden could, right? So that become one more additional input to their decision making. And as we were discovering in our study, it became a huge part of their trading.
Okay, thank you. That's really interesting. And so APIs, they're kind of one of many kind of new investment tools sort of powered by technology of the past, 10, 20 years. Why was it important to you and your colleagues to look into this in your research?
We thought that we are surrounded by products that we consume. And by and large, they create profits and benefits for us. And sometimes they are harmful, especially if we use them in a way that we shouldn't use them. We are fast going into an era that every day we have a new product. APIs and publicly available APIs are one instance of it. That yes, we consume, and yes, there are benefits to it, but there are also downsides and risks to it. And we did not feel that the general public is informed enough about it. So we started thinking about it. And this is a very, this is almost like investigative research, because tech firms are not going to be very open to share who is using their application, how they are using application. So it becomes an uphill battle to gather data the way that we know it, to address a company, ask for the user data, and can we do a fair analysis of it and say, what are the risks of using the product that you have, the digital product that you have created? Now, Yahoo Finance API was a very specific case. This was a tool that was available for 5-6 years, the way that we knew it, for free to everyone. And it created a culture around it. If you go to Reddit's discussion boards about trading, you would find articles after articles, discussions after discussions about how to use it, how good of a tool it is. So it was very popular, but also something happened to it that to the eyes of a researcher is a very great opportunity to understand the impact of that product, in that without any explanation, this API was shut off. When it shut off, it provided the perfect experimental situation for us, because now we could see, once you take away this product from the people who were using it, what is the change in the trades that they are making.
So, yeah, okay. So really motivated by the risks, the potential risks involved in having all these tools available at our fingertips. And like, these are people who are not trained. They might know some things, like, because, you don't get into this without knowing a little bit, but it's not nearly at the same level as institutional investors, as you said, and it's, you're doing this research to understand the risk. So based on your experiment, based on the setup that you just described, I'm curious what you found in that regard. How did the shutdown of Yahoo's API affect the people who were using it? So
when we started, I want to emphasize that at the start of it, what we could observe were trading over certain stock targets. We know, for instance, how many people have bought Amazon stocks in a certain day, how many people have sold it, in what volumes it was sold and bought, right? But we did not know a particular retailer's behavior, so we had to get a little bit innovative. We wanted to understand and differentiate between the way that retail investors and institutional investors are impacted. Our assumption was that Yahoo API is something that is already, or equivalent of that technology is already available to a institutional investor. There are usually bigger banks, they have experts, they have databases, they have all the means that a regular person would not have to access that data. So they wouldn't be impacted. And we know that there are certain stocks that are targets of institutional, and there's research that show that there are certain stocks that are target of institutional investors, and there are ones that are targets of retail investors. So we compared the two. So what I tell you is the comparison between what happened to those stocks that were heavily targeted by retail investors versus the pool of stocks that are usually institutional investors' game. What we noticed that in terms of volume, how much are we trading on the stocks that are related to the more pertinent to the retail investors, more historically traded by the retail investors? We found that by 8 to 10%, trading volume went down. And 8 to 10% is a huge number. It gave us a window of to what extent people were relying on that. What we also noticed was that the trades were better trades, the ones that were happening, in that if we assume that some people have a window of 1 month of buying and then selling, if that's the strategy that they are following, we noticed that they are making more money in absence of Yahoo API versus whenever Yahoo API was available to them, right? And of course, we were seeing that, the retail targets that are more heavily invested on are less risky compared to the time that the API was active.
Wow, that's incredible. So the removal of information actually improved their investment outcomes.
Counterintuitively so, yes.
So why is that?
So this is where we started digging further. We wanted to understand what is happening, and the data that we had was a bit macro. So retail traders do have, and this is previous research that shows us that there is this trap of overly relying on trends of historical prices. Historical prices are valuable source of information, but they are not the only part of it. We also know from previous research that whenever we give too much data to a person that doesn't know how to handle that too much data, they become paralyzed for decision making. So decision making paralysis is another element to it. But the basic element that we went to and start with was the assumption in behavioral economics that once there is illusion of control, we are going to change the way that we perceive risk.
So that's very interesting, because more information, it feels like it should be a good thing. It's empowering. We always hear about how information is power, and that it should allow us to make more informed decisions, and it should reduce risk, not increase it. But in this case, this makes sense. Like that, if to the untrained individual, that it would give you a false sense of confidence when making investment decisions. And now you alluded to this behavior kind of mimicking those of gamblers. So I'm curious if you could talk a bit about that, because I think a lot of people might not think of investing as, like, maybe there's some gambling elements, but not nearly as much as I think is being suggested here.
That's true. And we don't want to say that it's exactly gambling, but it's gambling-like behavior in that we have risk and we have information asymmetry. We don't know what happens with certainty. It requires the part that for me separates it from gambling is that in financial markets, the more knowledge you have, the more expertise you have, the better you could make a decision. So really information that you have aids and complements the knowledge that you have, but it doesn't substitute for it just because you have access to information. In fact, there are studies that are showing that, when people participate in games where they can count the cards, their tolerance for risk increases. They think that they could be more risk-taking because they have this illusion of control, for instance. To make the comparison between gambling and financial markets, there's the element of risk and there's the element of discounting the risk that I think are very similar. And in that sense, I think these behaviors are very similar to one another.
So let's say I'm an individual investor. I'm a consumer investor, and I've listened to this podcast. Now I'm aware that having too much, or that I need to be mindful of this bias. What are some actions I can take to maybe reduce my risk or try to make more sound investment decisions?
I would say think consciously about the fact that you need financial knowledge and financial expertise to make a good decision. Take into consideration that institutional investors that are making in long term more money take a different strategy than short-term strategies in investment. So to think that I'm not familiar with the market, I'm going to access information and all of a sudden it covers all these shortcomings that I have to these great minds in the market that are making very good decisions is an illusion. And one of the ways to avoid that, although I'm not a psychologist, is to remind mindful that there's a gap in expertise, there's a gap in knowledge. Read, access sources that tell you information about fundamental value of a stock that you are investing on, in addition to historical data that you are getting. A lot of these apps, a lot of what encourages quote-unquote algorithmic trading for retail investors, it awfully reliant of this historical prices, which are only one aspect of evaluation of performance of a stock. investment performance depends on something else, and reminding yourself frequently that it's important to look into other information. Read the annual reports of this stock that you are going to invest on. Read the analyst's analysis of what this company is doing. All that information is relevant. And unfortunately, some of these APIs, data APIs that are very popular in finance, overlook the fact that those ingredients need to be baked in to what is fed to the customers.
Yeah, and that's a good point, because pointing to what these companies can do to hopefully maybe deter this kind of risky investing. So like what can Wealthsimple or Robinhood or these other applications do to hopefully encourage consumers to take those steps, to look a little bit more deeply at their choices?
There are two ways, I think. There are two ways to answer your question. There's one for us to be visual about what they can do. And yes, is to put cautions for the customers that you need other type of information. This is just one input for you. But what it does is that it drives, remember that the volume of trading for us went down by 10% whenever we didn't have access to the technology. The minute we start cautioning to the customers that there's a downside to it, it drives the trading down. And I am not convinced when you have profit tied to that, it's necessarily something that is basically a corporation's responsibility then to react, right? At best, I think is wishful thinking. What I think might be a parallel question to the one that you're posing is that what we can do as a society, what our regulation bodies can do to help the retail investors. I give you an example. In U.S. SEC, the Securities and Exchange Commission, is responsible for protection of the main street. And if that's the mission that they have, then they have to not only think about the things that they regularly do. We go and talk to the corporations and say that, you have to disclose everything in your annual report. But do we look at the products that tech is injecting into the retail investors market for encouraging them, sometimes pushing them to make trades? And this is where I think that we are still in a very pre-tech era of regulations and policies that we have. And some of those policies are very slow to move forward, understandably. But with the advent of technologies that are being pushed to the public and are making it very easy for the public to do things that previously was not possible, I think it becomes more and more realm of the policy to catch up with tech and understand and study it as any other product. We always have standards about the products that people consume, and I think that that would be a good idea to protect retail investors.
Yeah, definitely. There's definitely some catching up, and it's not just in this space. It's in every technological space. I think there's some catching up to do from a policy side. Yeah, it's really interesting. So I think maybe to end, just one last question. So, I mean, a lot of these technologies, like, they're supposed to be like democratizers of investing. Like, it's supposed to make these things that are traditionally held, like, reserved for institutional investors, for Wall Street, it's supposed to make it accessible to the people on Main Street so that they can make more investment decisions. So they can compete in a way with these other big investors and hopefully participate and benefit from the market and from the economy. So I'm just curious, like, I don't know, does this technology live up to that promise?
I think to some extent it does, but we have to be very mindful of the fact that there are limits to it. And I'm a huge proponent of regulated behavior, and I think that there are ways, this is the way that we always have consumed tools. Of course, the way is not to shy away from the tool, not that it is possible, but the way is to find a way to use this tool so that we could benefit from it. And I think that there is work that needs to be done, but technology is an agnostic thing, is an agnostic tool. It really depends on the way that we wanted to create it for proper use for the way that we are using it. So I'm optimistic that the more we understand how they impact people, how they impact their biases, the more we also are capable of creating them in a way that they don't bias people, right? So our jobs as researchers is not just to understand where people commit biases, but also to understand how to correct for those biases. What are the indicators that tech could do to essentially help people to get away from that biases, right? Some of it, like we mentioned, there's business ideas and business opportunities that would come up. Tech is always like that. That's why it's the most vibrant area of investment. Some of it, us as a society learn better, humans learn better. It becomes part of the public education. So we hopefully over time learn better how to use these techs. So short answer, to some extent, but I think that there is still work that needs to be done.
Well, Professor Havakhor, this is amazing work. I really appreciate you taking the time to share, to speak about it with us today, and thank you so much.
Thank you very much. It's been my pleasure. Thanks for having me.
And that's our show. What an incredibly interesting conversation. I was particularly blown away by the fact that when Yahoo's API shut down and users couldn't access their information like usual, that they actually started to make better investment decisions than they did before. Thank you so much to Professor Taha Havakhor for joining us today, and thank you, listener, for joining in. Don't forget to subscribe to our show if you haven't already, so you never miss future McGill Delve episodes, and we also have a newsletter, so you can receive even more great thought leadership from the Desautels Faculty of Management delivered straight to your inbox. You can subscribe at delve.mcgill.ca. McGill Delve is the official thought leadership platform of the Desautels Faculty of Management. My name is Eric Dicaire. I'm the assistant editor at Delve and a producer for the show. Saku Mantere is our editor-in-chief, and he also wrote all the original music. Thank you so much for listening. Until next time.